Let's talk about inventory valuation. There are circumstances where the value of our inventory may decline, even below what we paid for it, below the cost. Cost is usually our basis for inventory valuation, right? But if we think about if the revenue producing ability of this inventory declines below cost, we kind of have an issue when we think about assets by definition and expected future benefit. So if this occurs, what we do is we measure our cost against what's called net realizable value, and we take a conservative approach and we choose the lower between those two values and assign that to inventory, and likewise that value would be attached to inventory on the balance sheet. So we're looking at lower of cost or net realizable value. And there's two methods. I want to touch on the first, but we're going to wind up using the second. The first way we can go at this is the cost of goods sold method. So here is where we examine both of these values. We choose the lower of our options, but if you think about if we have a loss in value and we write down inventory to that lower value, we have a portion that is a loss. Just like if we wrote down any asset, we have a loss, it hits the income statement, a negative effect on net income. The cost of goods sold method does this. Depending on what that loss is, we would debit cost of goods sold and then credit inventory. This does the job, right? It gets inventory down to where it should be. It debits cost of goods sold. That has the appropriate bottom line effect on the income statement. But if you think about this from a user perspective, or even internally, this journal entry really doesn't tell us much, because this is going to get buried in all the other cost of goods sold debits. So if we look at this at the end of the year or end of the month, we really can't pinpoint what portion of this was due to the inventory decline. And this compromises the usefulness of this information. So a superior way to do this is what we call the loss method. And so here we'll wind up debiting a specific loss account due to the decline in inventory value. And then we'll create an allowance account so that we can see these items segregated from the regular cost of goods sold. So the journal entry for the loss method would look like this. We would debit loss due to decline in inventory, and then we would credit our allowance. We could call this inventory allowance related to this loss. How would this appear on the income statement? Because the end game is, why is this more useful? So in the income statement, if we took this second approach, our loss method, it would look like this. We would naturally have our revenue or sales as the top line. We'd retain an accurate cost of goods sold account and have an appropriate and useful gross margin. Hopefully you can see that, or gross profit. Below gross margin is where we normally go into our operating expenses. This is where we would find this loss due to decline of inventory. So now we have this segregated in the income statement. It's more useful. From the balance sheet side, this will resemble our work in accounts receivable, where we have accounts receivable, we have that allowance due to uncollectible accounts, and then our net accounts receivable. This operates the same way. We would have inventory on the balance sheet, what we paid for it at the original cost, and then if we have a loss due to inventory decline, we would see that allowance to reduce inventory here. And then we would have net inventory at the lower of cost or net realizable value. I want to go into a problem, but before I do, let me just address one more thing for our notes. This is the lower of cost. We know that's the original price we paid for the inventory, or net realizable value. So what exactly is net realizable value? Net realizable value is our estimated selling price for the inventory minus any estimated cost that we will incur to sell the inventory. Selling costs, cost to complete the inventory, get it ready for sale. So with that, let's go to the handout and we will look at the first problem, which is E9-3. And here it has 8 different items or SKUs, quantities for each, the cost, the original cost we paid for each of these on a per unit basis, our estimated selling price and estimated cost to complete and cost to sell. And it asks us to determine the amount that we should carry this inventory at. So we're going to use the lower of cost or net realizable value to do this. Let's take a few of these, starting with item 1320. We know the cost is $3.20. Our estimated selling price is $4.50. Now we estimate it's going to cost $1.60 to complete and sell this. So our net realizable value for item 1320 is $2.90. If we look at the next one, the cost that we paid for item 1333 is $2.70. We anticipate to sell this item for $3.40. We're estimating that to complete and sell this, it's going to cost us $1. So if we're selling it for $3.40, we have $1 selling cost. This means our net realizable value for item 1333 is $2.40. So you guys see how this works. I'm going to go through these next 6 and just put the net realizable value for them. For item 1426, it's $3.60, $1.85 for the next one. For item 1522, the net realizable value is $3.10, and so on. So now we've determined our net realizable value. We'll compare this to cost. Whichever is lower is going to be the value that we're going to take and apply to the balance sheet. For item 1320, net realizable value is actually lower than what we originally paid. We have a decline in inventory. We're going to wind up debiting that loss and crediting the allowance account to reflect that loss. Here, net realizable value is lower. Same. Look at this one, okay? For SKU 1522, net realizable value is a little higher, 10 cents higher, so we're going to go with our original cost and apply $3 per unit for the cost for that item on the balance sheet. And it looks like net realizable value is lower among the next 2 SKUs. So if we look at the handout, we've pinpointed which which is lower for each item, the cost or net realizable value. The next thing we would do is take these per unit costs, look at the quantity that we have, multiply that by the number of units, and then we will have our value for the balance sheet. If we do the math on this problem, E93, we wind up arriving at a total inventory value using the lower of cost or net realizable value for $21,565.